based on industry guidelines, a balance roughly between 200,000 to 300,000 is something that's ideal for an SMSF, considering the cost of running an SMSF. Common mistakes is simply not distinguishing or understanding between personal and business use.
I think this is a great opportunity there then when it comes to Aussies just having these tax advantages in mind to know that they've invested so hard for their future.
SMSFs, again, are meant for retirement benefits, is meant for your long-term retirement, and you have to always meet the sole purpose test to ensure that you're not accessing any of the assets for your personal use.
Welcome to the Property Nerds, where in this episode, we chat to our repeating guest, Ronesh from the Incentum Group. We go into the world of SMSFs. It's becoming very common when it comes to investing in property through an SMSF. But should you speak to a financial planner? Should you speak to an accountant? What are the differences? Where are the common balances that people have set up when they get into an SMSF? What's some crazy high balances Ronesh has seen? And some of the lower ends and where they might need to be careful about setting one up. Now, SMSFs is a complex world, and Ronesh is going to help us unpack this in today's episode. But before you go and act on any of the guidance from this episode, just remember, this is a chat amongst four property nerds talking SMSF. This isn't financial advice. Go speak to your qualified financial planners or accountants to seek more independent guidance and advice for your scenario. But for now, let's tune in, chat to Ronesh from the Incentum Group, and speak about all things SMSF.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Ronesh, welcome back to another episode with us here at the Property Nerds. And last time we were talking equity loans, trusts, getting quite technical. Today we're going to run it back, but on SMSF. So something that you're seeing quite common, is it coming up more than ever?
Yes, SMSFs. It's an interesting vehicle. Used to be less used, I think maybe 15 years ago, but it's been a very common vehicle that a lot of people are entering into at the moment. It's got various tax benefits, long-term benefits for retirement, but it's something that's very much common right now. And we see that a lot of clients of ours are getting to SMSFs and wanting to grow their portfolio and their wealth.
Makes sense. And SMSFs are set up by accountants at time. Obviously, you do a lot of them for our clients, but then there's also SMSFs that get set up by financial planners. So if we go down the financial planning side, what do they specifically do that's different to an accountant for setting up an SMSF?
Sure. Financial planners are more concerned about your overall financial goals, your retirement goals, your overall asset position as well. And they look at SMSF as a part of your overall financial plan or advice. Financial plans are usually required to issue a statement of advice. That is something that accountants do not issue. And that they do look after the investment side of things of assets within an SMSF structure. When it comes to accountants, we're more focused on tax planning, the structure setup, and also the annual compliance of SMSFs. So we focused on setting up the trust deed, registering the company, registering the SMSF with the tax office. So that's the structure setup. Then we're also looking at, once the SMSF is up and running, we look at annual compliance. So preparing the tax returns, financial statements, and we also manage the audit of the SMSF structure.
So would you say that the person setting up an SMSF when working through an accountant, like, some of the clients have with yourself, it's more like they've done their own independent homework, they feel comfortable to do it, and they're now seeking your guidance to act on completing that setup? Is that kind of the more, like, the simplified way there as well, what they do, where it's different from the financial planning side?
That's correct. So when clients come to us, they have made the decision that they want to go into an SMSF structure, and they give us then the instructions and the go-ahead to set it up for them. Whereas usually the financial planners are there discussing with clients as to should they have an SMSF, what are the pros and cons. So the financial planners have a slightly different role, and they've got a license, an FSL license to provide that advice.
So with regards to lump sum contributions to SMSF, I know that there's a way you can like backdate additional contributions for 5 or 7 years, and then you can forward date it. Like, can you talk about some of the, like, what's the cap in terms of if you were to put a lump sum amount of money into super, what does that look like?
Sure. So contributions into super are of two types. You've got your concessional contributions, which are your salary sacrifice, your employer super, as well as personal contributions. The concessional contribution cap is 30,000 per year. And if you pay up to the 30,000 cap, you do not pay any tax. But there's a caveat. If you're a high income earner and you earn more than $250,000 in income, then you're up for the Div 293 tax. So the tax office is quite generous, but for high income earners, you end up paying an extra 15% on your super contributions. The second type of contribution, which is the non-concessional contributions. Now, when it comes to non-concessional contributions, you have a cap of 120,000 per year, but you have the ability to bring forward 3 years contributions as well, which equates to about $380,000 of contributions. There is a condition. You have to be below your threshold to be able to make those contributions.
Makes sense. So I think the best thing you're saying to start off with is like when you're reviewing that pre-tax meeting, like pre-tax time meeting, and you're trying to figure out the strategies. I think business owners have a big advantage here as well, right? Who often don't put enough super aside for themselves quite often, but this allows them to basically go, what can I catch up on, review it with my accounting team, and then look at it and go, okay, here's a way for not only tax saving, but also super balance, wealth growing activities. And this is where these catch-ups come into play. Is that right?
That's quite correct. As tax agents, we have access to your tax and superannuation records. So we're able to see for the last or prior 5 years, your concessional contributions, your non-concessional contributions. So we're able to advise you as clients that these are the caps that are available or unused amounts that are available, and what are the tax benefits for it. And then we leave it for our clients if they're able to make that contribution based on their cash flow.
And that cap was per client, right? Per customer.
Per individual.
Jeez, that's a lot.
Yes.
So
yes.
In a case where a client wanted to put additional to that, do they just have to pay tax on the difference on what's over?
That's correct.
Yeah.
So it can become expensive if you exceed the caps, and the tax office does penalize it, and you could sometimes end up paying 93% in tax. So you always would want to stay below the caps, and that's quite important.
Cool. Continuing the topic of tax, but maybe not so much for contributions, but income and capital gains when you are making a profit. A lot of clients are going and investing in super and their SMSF because of these benefits of tax. What are the different rates that we have to consider, prior to retirement or after retirement when it comes to income and capital gains tax?
That's a very good question. So the SMSF is the lowest tax entity in the Australian tax system. When you are in accumulation phase or when you are working and you have a job, you are making contributions to the SMSF. That's what we call as the accumulation phase. So there is flat tax of 15% on income, and the capital gains tax rate drops down to about 10%, provided you've held the asset for more than 12 months. So those are the rates in accumulation phase. When you retire, meet a conditional release, you go into pension phase, the portion of the SMSF balance that's supporting your retirement income becomes tax-free then. So the income and capital gain supporting your retirement pension becomes tax-free. So that's a very good tax outcome for an SMSF.
And so they should for the Australian family and the Australian couple that's building wealth, not on the pension, focusing on what they can contribute to their own retirement. Like, I think this is a great opportunity there then when it comes to Aussies just having these tax advantages in mind to know that, they've invested so hard for their future. Like, this is a vehicle that allows it, whether it's SMSF or whether it's just, through super and not self-managed. I just think there's such an important role it plays in Australian wealth building when it comes to that. When it comes to SMSF, though, people can make mistakes too, especially when admin, money management, what they do with funds, what they spend it on. what sort of common mistakes come up in people managing their own SMSFs? And when I say managing, they're not doing their own returns and all that, still working with an accountant, but just them as the owner of that SMSF. What are the mistakes you see them commonly make, and what can it cost them?
Okay, that's a very good question. We're human beings who make mistakes. Our clients also make mistakes, but our job is to educate them. So common mistakes is simply not distinguishing or understanding between personal and business use. Clients tend to use the fund's bank account for personal expenses or take money out for loans as well from an SMSF bank account. So that's practically a no-no from a tax perspective, from an audit perspective.
Big no-no.
So, you got to keep the SMSF bank account only for the SMSF use, and there should be no personal use of SMSF funds. SMSFs, again, are meant for retirement benefits. Is meant for your long-term retirement. And you have to always meet the sole purpose test to ensure that you're not accessing any of their assets for your personal use. Another common mistake that we do find is record keeping with our clients. So every transaction within an SMSF should be documented, should be provided with a receipt. There should be a trail through bank statements or contracts supporting purchase of assets. So we see clients making the mistakes of not having proper record keeping. And that can become a bit more messy and time consuming when we get to do the work. So we always try and educate them to make sure that you've got proper documentation in place.
Loving the show and keen to invest? Well, book your free discovery call and we'll actually walk you through how to build a high growth portfolio without all the guesswork. Just jump onto the link in the show notes or visit investorkit.com.au to book your discovery call. And now let's get back into the show. So you got two mistakes there, one more administrative and one more more intentful and using it for the wrong purpose or the wrong funds, which are pretty big mistakes on that part. What can the cost be of some of these penalties or impacts to someone who's making these mistakes?
Sure. So the penalties, the ATO is very strict. The penalties can include removing the complying status of a super fund. So you'd be up for top marginal rates on that super fund income, and you could lose that complying status completely. So we do auditor contravention reports for SMSFs that do make mistakes where clients are not following the rules. The tax office looks at the contravention, and if we have rectified the contravention, then the ATO is lenient, but we definitely don't want to make mistakes.
Yeah, and that's on the administrative and those types of mistakes. Is there very large mistake penalties though? If someone's not just tax rates are higher, but someone just took it out and went to the casino and put it on blackjack or something like that?
No, that does happen, and
that's crazy.
That has happened, I guess, as well. But then the tax office would make that SMSF non-complying, and then you would lose all the benefits of the tax benefits, as well as the penalties would be implied on
fines, stuff like that.
That's correct. Fines.
How big are some fines that you've seen in this world, or heard about? Because I'm sure accounting talk, other accountants, Hey, Ronesh, someone just did this.
They can be large sums. Luckily, my clients have always been compliant.
We made sure that they've been compliant.
Good accountant, mate, of course.
But it can be huge amounts of money. It can be huge amounts of money.
Yeah, that's you wouldn't want to be that, especially your future retirement, hardworking. Yeah.
So 3 parts. What's the most common balance that you see someone come over and want to start an SMSF? And then what's the lowest balance you've seen, and what's the highest balance you've seen?
We're talking dollars and cents here, Ronesh.
It's a range of clients who do come up and say that they want to start an SMSF. We've seen, based on industry guidelines, a balance roughly between 200,000 to 300,000 is something that's ideal for an SMSF, considering the cost of running an SMSF, the setup costs, the compliance costs. So that's where the cost benefit makes sense and practical. Maybe the lowest one, we've seen so far is about 100,000. That's where it's not ideal, and
it's tough.
and the
It's tough to
expenses
finance.
are high for the SMSF. The reason why they would have set it up is because they just want to get into a specific investment. So it again comes down to their purpose, but that's not an ideal amount. And we've seen clients, from high net wealth family groups with funds of more than 5 million and above, who have have super funds.
And does those large balances largely come because of group-based pooling, like multiple family members coming together? Is that kind of like the thing there?
That's correct. So you can have up to 6 members in an SMSF. So where you've got large family groups who all want to be part of the same family super fund and have contributed and brought in their balances.
Yeah, I think like that's someone trying to, have a cool status, like, oh, we're a family office here in our family. You know what I mean? Like something cool like that. But $5 million, that's a big fund. I bet they're not so happy about those tax laws that just came in recently, right? They talked about recently as well. Have you seen a lot of chatter and chitter happen in some of your clients amongst that 3 million plus range?
That's there's been a lot of talk. I guess we're also seeking guidance from the tax office as to how the unrealized capital gains is going to be taxed, what are the implications, and how we would administer it from year to year. So there is definitely a lot of uncertainty in the SMSF environment for these large SMSFs.
So what happens if a client pays unrealized capital gains tax and then the property goes down in value? Is the government going to pay back?
We hope we get a bit more guidance on that, but that's definitely something that's been proposed and has gone through right now. It's just we're trying to look at what the actual practical guidelines are going to be when we come across those situations.
So Ronesh, when it comes to family trust, discretionary trust was one common used term that happens, but we've also heard of something called unit trust as well. And why I want to ask about this is that one of the cons of buying property in trust, say for example in New South Wales, is that people often find with discretionary trusts, the land tax component's pretty high. So are there differences in land taxes between unit or discretionary trusts in places like, say, New South Wales?
Yes, Arjun. So New South Wales has every state has separate rules of regarding trust and how they should be taxed for land tax purposes. In New South Wales, there's a distinction between a unit trust and then special trusts such as a discretionary trust or a family trust. So the rates are higher for a special trust such as a family trust and a discretionary trust, and a unit trust gets preferential rates. So it's again coming down to your situation, your purpose of that trust. That makes a distinction whether you choose a unit trust as opposed to a family trust. We tend to see with for our clients where we've got unrelated parties, they tend to form a unit trust structure when they purchase property, because then everyone has a fixed entitlement to that unit trust. We usually see family trusts in the case of families because they have the discretion and there's no fixed entitlement. So the fact that there's fixed entitlements and non-fixed gives the main distinction, but the land tax office does have separate rates for the two types.
And how big are the differences in the rates? Are we talking maybe 50K, 100K here and there? Or is it, what sort of threshold roughly are you getting in a unit trust versus a discretionary trust?
So a unit trust gets, in New South Wales, gets a land tax free threshold for $1 million approximately. And a special trust, which is a discretionary trust, actually doesn't get a threshold. So it's taxed at the first dollar.
That's a big thing to be aware of. Like that's something I've learned very recently, actually. So that means people could be saving thousands of dollars per annum just by considering unit trusts. Now, Jack, I might come to you at a later episode and we might deep dive into unit trusts because there's a bunch of lenders that do and don't. So I'd love to unpack that. So stay tuned for anyone watching. In another episode, we'll unpack that further. But Ronesh, that's really helpful to know. And more on just knowing those thresholds are a big difference maker to investing in trust as well. Well, Ronesh, I've got one last question, and this is more of a bit of a back to basics for SMSF for those watching. Imagine someone contacts you tomorrow and goes, hey, Ronesh, I have a few $100,000. I've taken up my own advice and guidance and sought that out from professionals. And I feel like I'd like to now proceed with setting it up. What are typical steps if we just go to the macro steps, not to the micro? And what are timelines one can expect for something like this?
Sure. There's various steps involved in getting the SMSF structure up and running, and also then the subsequent events that you got to do to make sure that you've got a self-managed super fund that's able to be ready to make investments. So the first step is usually the structure setup. Again, we do set up SMSFs with corporate trustees. We would ask and request for all the information to set up the core structure, the corporate, and then the trustee. Subsequent steps would be we'd register the trust, the SMSF trust with the ATO, and get the compliance status, get the AB and the TFN applications through. Then the next step would be to set up bank account. So we get our clients to choose whichever bank they want to go with and set up an SMSF bank account. And then the next step is to do the rollovers. So clients would request their public funds to do the rollover into their SMSF bank account. And that's a decision they make whether they want to do a partial rollover or full balance rollover. Some of the topics, I guess, that we do highlight to our clients is insurance. Usually most of our clients have insurance in their public funds, and depending on their need, whether they want to continue those insurance, they tend to keep a partial balance in their public funds. Most clients who are older, they may have to do medical examinations to get new insurance in their SMSF. So you got to weigh all the costs and the time that goes into doing that. And so insurance is definitely something that we do highlight to our clients to consider. And then once the SMSF is up and running, they make the decision of the investment. They have a financial planner who makes those investment decisions for them. So it's a journey. I think we see with our clients, we guide them through the process at the end of the day, and then we educate them to make sure that they're complying with the SMSF rules.
And timing wise, 4 to 6 weeks usually for something like this?
So from setup to the point where you get the rollover into the fund, it can take up to about 5-6 weeks. Yeah,
makes sense.
That's correct.
Awesome.
But it also depends on the public funds who's processing the request. If they're busy, sometimes they can take a bit longer.
They don't want to let the money go, right?
That's true. That's true. But it's the client's money, so they have to send it
100%.
over. No, it's usually 4 to 6 weeks that can take pretty much.
Makes sense. Well, Ronesh, thanks for unpacking the world of SMSFs today. How can people reach out to you when it comes to SMSFs if they're set on setting one up and wanting to learn more about it?
Sure. We welcome our clients to visit our website, so incentumgroup.au, and we've got client forms there that they can fill out if they're wanting to set up an SMSF. We're definitely happy to have a chat with them and understand their request, as well as we can then send them an information request on what information we'd need to do an SMSF setup.
Awesome. Thank you so much, mate. Appreciate you jumping on the show and talking all things SMSF with us today.
Sure. It's my pleasure, Arjun, and the team. Yeah, happy to be here.
Awesome. Thank you so much for tuning into this podcast. To hear more like this and to help us spread the word, don't forget to leave us a rating and follow along for our next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.